Hello, everyone. Thank you very much for joining us once again today. Welcome back. As you know, we are discussing UAE corporate tax and we are discussing transitional rules. In our last lecture, we discussed the very basics of the transitional rules. And in this lecture, we'll try to address the second provisions of the Article 61(2) of the UAE corporate tax law, which requires that the opening balance should be carried on based on the arm length principles. So we'll just go through the previous lectures as well, and then we'll discuss on the second phase of the transitional provisions. Before going to the webinars today, that we just wanted to highlight whatever we have discussed till now. We have already conducted 27th webinars on the UAE corporate tax law, and these 27th webinar that we have conducted, these are those webinars that we have conducted after the announcement and after the implementations of the law. Last lecture discussed transitional provisions, and a webinar before this we discussed a small business relief. In a webinar 20 transfer pricing, we already discussed application of corporate tax on the manufacturing and processing firm. We'll discuss application of corporate tax on the trading companies. Participative interest, free zone consultation paper were discussed in detail. We discussed free zones, reliefs, tax losses, tax grouping, small business relief, and so many others webinar. Coming back to the today's topic, these are transitional rules, arm length opening balances, arm length fair market value opening balances, market value opening balances. So this is a topic of the day. In our previous lecture, in our previous webinar, we have discussed that Article 61 of the UAE corporate tax law requires that the opening balance for the corporate tax purposes shall be the closing balance sheet prepared for the financial reporting purposes under the accounting standards on the last day of the financial year that ends immediately before the first tax period. We'll discuss one example as well that we'll cover in our next slide. Then we discuss that the law requires Article 61(2) of the law requires that the opening balance sheet must be prepared taking into consideration the arm length principles. We all know this, what is the arm length principle, then again we'll discuss in our coming slides. Anti-abuse rules, these application, the effective date of the anti-abuse rule as given in the Article 70 of the decree law. This is within 15 days from the date of the publications of this law. But specifically for this provision of the law, they said that the provisions of Article 50 of this decree law shall apply to transaction and arrangements entered into on or after this decree law. So basically, there no grace period for the Article 61(3) of the law. It will be applicable immediately after the publication of the law in the official gazette. We'll discuss one example that we discuss X Limited had financial year starting from Jan to December, and effective date of the law starting is 1st of Jan 2023. There was one error in our previous discussion. I just wanted to highlight this year would have been 24, it would have not been 23. So effective date of the law for the X Limited will be from the 1st of Jan 2024. I really appreciate it that someone has already pointed it out when I posted this on the LinkedIn. Someone has written there, out of you might be, someone has written there, really appreciate it. So thank you very much for this. So what I'm going to discuss, X Limited had financial year starting from the previous financial year. The tax period will be started 1st of Jan 2024, not 2023. Furthermore, we will start the 1st January 2024, immediately preceding financial year starting from 1st of Jan 2023 till 20. So basically, my financial year is starting from Jan 2023 to December 2023, and corporate law tax law will be starting 1st of Jan 2024. We had in a previous lecture we have made this head. So for the financial year 2023, X Limited will be liable to prepare the financial statement and number reflecting in the closing balance of the year 2023. 2023 will become the opening balance for the tax period starting from Jan 1st, 2024. So whatever the closing balance, what are the closing balance reflecting in the balance sheet of the financial year ending on 31st December 2023, those closing balances will be considered as an opening balance for the tax period starting from 1st of Jan 2024. Then we discussed that the Article 61(2) requires that the opening balance for the first tax period should be based on the arm's length principle. This requirement is introduced. What the reason of basically what are the closing balances? Might be people are taking the leverage, it might be the businesses are not paying the proper tax in the future. So this was the reason of introduction of the transitional period. I just wanted to give you an example. I think we have discussed in a previous webinar as well. If you have a closing balance of the machinery, arm length price is assuming 1 million. 1 million is the arm length price, but you are having a transaction with the related party, and related party has sold this machine to you at 5 million, assuming. So in the future period, this depreciation is allowable for tax purposes. If the transaction would have been executed at the arm length, depreciation that would be allowable in the future, this depreciation rate would be applicable on 1 million. Since this is a related party transaction has been controlled, the purchase price of the machine of 5 million. So the businesses will be claiming more depreciation in the future. Once the businesses are claiming more depreciation in the future, means their taxable profits will reduce in the future. They will be avoiding the tax. Why? Because they have controlled this transaction. By controlling this transaction, they have increased their deductible expenses. Once the deductible expenses has gone up, ultimately their taxable profits has come down. So this was the reason of the introduction of this provision in the law, that the businesses needs to carry whatever they write, what the proper expenses. They should not be able to play with the numbers, should not be able to get the more depreciation for allowable. They should not be able to reduce their taxable profits in the future. So this was the reason of the introduction of this law, this provision. Then we said that any transaction arrangement between the related party meets the arm length standard if result of the transaction are consistent. Basically, whatever we have discussed already. What is the definition of arm length price? We're discussing one line. Whatever the price that you are charging to the third party, the same price should be applicable for the related party. The same price should be applicable for the connected person. Whatever the price business is charging to third party, the same price should be applicable for the related party, and the same price should be applicable for the connected person. This is the definition of arm length price. Then we discuss one mechanism, how we will carry forward the closing balance given in the last balance sheet as an opening balance for the first tax period. So discuss this mechanism that carry forward balance sheet balances not on the P&L. So we will not consider the P&L balances because these are for the period number. Balance sheet numbers are as on numbers. So whatever is reflecting in the balance sheet, we will carry forward those numbers. TP issues arises on a transaction with related party and connected person. This, whatever it has been written, this is very correct. But I just wanted to give more clarification on this. TP issues arises on the transaction with the related party for sure. These arises with the transaction with the connected persons as well. But there is one more important thing. I'm going to enhance the spectrum of the law. Basically, this TP issue, if your closing balance reflecting in the balance sheet, might be you have a transaction with the third party in the past, there is a possibility, I'm just repeating, there is a possibility whatever is the balance whatever is reflecting in the closing balance sheet, that balance is not on the fair value price, on the arm length price. There is a possibility. So we can say this, there is a possibility if we have a transaction with the related party. Let me switch it off this WhatsApp, please. Taking a lot of time. Apologies for this. Sorry. So what I was discussing, basically, we said TP issues arises on transaction with the related parties and connected person. Yes, this is correct. But whatever the law is asking closing balance should be carried on the fair value price and the arm length price. I'm asking, there is a possibility the business had a transaction with the third party. Whenever this transaction was executed, everything was on the arm length, fair value. But with the passage of time, the value of the asset, the value of the liability might be it has changed. If the market value of the asset is different and whatever is reflecting in the closing balance sheet, this is a different, we need to bring it up to the market value. This is a transaction with the third party. It was not a transaction with the related party. It was not a transaction with the connected person. So we can say that there is a possibility that third party transaction is also not reflecting on the market value at the fair value. We need to convert that amount into the fair value as well by considering the arm length price. So whatever the mechanism we have discussed, more or less this is same. Unsettled transaction previous period profit and loss impact will not be in the retain, will be in the retain. And yes, this is correct. Unsettled transaction previous period balance and impact will be on the face of the balance sheet. Yes, this is correct as well. Intercompany financial assets and financial liabilities in the form of intercompany, it will be in the form of intercompany. Yes, this is correct. Other asset liability, I'm asking, other than this, there will be other balances as well that we need to consider and the market value. So we need to consider the unsettled transaction with the related party and connected persons. Then we need to identify their fair market value, then revise the opening balance that will become the carry forward balance for corporate tax purposes. So going back to the 61.2, as I discussed, this requires carry forward balances needs to be carry forward on the opening market price, fair value, market value, arm length price, whatever you wanted to name, give it, you can give any name to them. So opening balance is referred in clause 1 of the article shall be prepared taking consideration arm length principle in according with the article 34 of the decree law. So what are the transfer pricing? It has been defined in the corporate tax guide. They have given, this is the arm length price. They have defined the arm length price into the guide. They say a transfer price should be considered to meet the arm length principle if the price between related parties is consistent with the result that have been realized if the party to a transaction were independent from each other or had engaged a similar transaction arrangements under similar circumstances. Means if you would have been dealing with third party, whatever the price that you would have charged from the third party, the same price would be applicable for any transaction with the any other party. This is the arm length principle. So basically, at the high level, I can say we will be required to do the analysis of the whole balance sheet. Whenever we are going to do the analysis of the whole balance sheet, there will be assets, there will be liability, there will be current assets, non-current assets, current liabilities, non-current liabilities, equity, all these things will be in the balance sheet. So some of the balances in the balance sheet will be that will not have any impact in the future tax period. Some of the, I'm repeating, some of the balances will be reflecting in the balance sheet that will not have any impact on the taxable profits of the future tax period, like cash and bank. Cash and bank itself will not have any impact on the taxable profits of the future tax period. Transaction with third party. There will be certain transaction that will be with third parties, certain transaction will be there that will be with the related parties. There is a possibility. If the transactions are with third party, we need to look into this. Is this a recent transaction with the third party? If the entity has made a recent transaction with the third party, most probably whatever the value of the transaction which is reflecting in the balance sheet, that will be the fair value, that will be the arm length price. We will not be required to make any adjustment for that amount. I just look into this example. There is a party A. This party has bought one machinery from third party, assuming B Limited. A has bought machinery from B Limited. A and B are not connected persons. A and B are not related parties, but B is a third party for A Limited. So whatever the price has charged by B to A, assuming this is a 1 million, and this transaction has been executed just around 1 week before, assuming. If this transaction would have been executed between two parties, which are not related parties, which are not connected parties, it means this is a recent transaction, means B Limited would have charged the price at the market price, at the arm length price. So whatever the value reflecting of this machinery in the books of closing balance of A Limited by the end of 31st December 2023, this 1 million will be the market value. This is quite obvious. For sure, B will not be selling anything to them below the market value. B will not be selling anything to A at the A will not be ready to take the machinery above the market value. B will not be ready to sell below the market value. So whatever is the price reflecting in the financials of A, it will be the market value. So once this is the market value, this is a recent transaction, we will not be required to make any adjustment unless and until something unusual is happening. Extraordinary events are happening. Second, if we have a transaction with the old transaction with the related party. Second possibility is the business has a transaction with the related party, and these related party transactions are old transactions. Once these old transactions are with the related party, there are two possibilities. Might be whatever the assets or liability reflecting in the balance sheet of A Limited, might be they have very recently revalued the asset, revalued the liability. If they have revalued the asset or revalued the liability very recently, again, we will not be required to make any adjustment because it will always be already be reflecting almost on the market value. So, but if there was a transaction with the related party, this was an old transaction, any revaluation has not been done. So once revaluation has not been done or revaluation has been done in the past, so now might be there is a possibility that the value of the asset, the value of the liability is different, whatever the reflecting in their books, because this is a transaction with the related party. Moreover, this is a transaction, old transaction. Assets or liability has not been revalued, so we can assume that we need to look into this transaction very carefully, and we need to bring it up the market value in the balance sheet that we will use for corporate tax purposes. So third category, second category, as I mentioned, there is a transaction, there is a possibility that the effect of the transaction is reflecting in the balance sheet where the transactions are with the related party. If these are the transaction with the related party, in case of related party transactions, now it depends where is the seller. If the seller is in the tax jurisdiction where the transfer pricing rules are applicable, we can assume for the time being, whenever the seller is selling anything, whenever the seller is selling anything to A, to the party, to the business which is based in the UAE, that seller would be charging the price as per the market value because TP rules are applicable in their respective country. Just look into the example that one company is based in UK. UK is a jurisdiction where transfer pricing rules and regulations are applicable. Buyer is based in the UAE. Whenever the buyer might be they have bought anything in 2023 or in 2024, whenever they bought anything from UK, we can assume that the UK supplier has charged them a price as per the market value. Risk is a little bit less as compared to the jurisdiction where the transfer pricing rules and regulations are not there and the parties are connected parties. Again, it depends. If there's a related party transaction and seller is based in the jurisdiction where TP rules are applicable, means we can assume that the risk is minimum and we can assume seller would have charged the price at market value. But if this is old transaction, again, might be the value of the transaction has changed, might be they have done the revaluation. Might be they have not done the revaluation. Even their transaction with the related party, if the business has done internal revaluation, means whatever the price reflecting into the market, it will be the market price. So we need to look into this basically. This we cannot set straightforward principle. What is the hard and fast rule? This is the hard and fast rule. We need to go, we need to do the revalue everything. No. First of all, we need to do the proper analysis of the balance sheet. We need to identify which balances will not have an impact on our future taxable profit. We need to eliminate it. Then we need to identify, okay, what are the balances, what are the transaction effect of which is reflecting in the balance sheet with the related party, with the third party. When this transaction has happened, what are the situation, what are the circumstances? After considering all these things, we would be in a better position to know, okay, these are the assets, these are the liabilities, these are the balances that we need to revalue. We need to bring them as to the market price. So blindly we cannot follow, we cannot set straightforward hard and fast rule. This is a rule that we need to follow. No, we need to do a proper analysis of the balance sheet. Then we'll be able to proceed further. We need to value it. We need to consider the fair market value that will be used for tax purposes. In our coming slide, almost I have discussed whatever we have discussed on this slide. In our coming slide, almost we have discussed the same thing, but through the examples. Like certain balances are cash and bank, reflecting in the balance sheet of the latest financial year, will not have any impact on the future taxable profit. We can therefore exclude these balances from our analysis, as we discussed earlier. Then discuss certain balances that recent transaction with third party. These recent transaction with third party will already be reflecting on the market value. We are not required to make any major adjustment there. Just look into this example. A company purchased machinery from a third party just before entering into tax era. The value of the machinery showing in the balance sheet will almost be same as per the market value and may not require any major adjustment. If the sellers are based in jurisdiction where the transfer pricing rules apply, we can assume that the seller has already charged an arm's length price and the risk of non-arm's length price are very minimal. Therefore, for the recent transaction with such sellers, a fair market value for asset will be showing in the balance sheet of the latest financial year. Just look into this example. In August 2023, a UAE-based company, Cherry Limited, purchased machinery from UK-based subsidiary, Berry Limited, and the value of the machine was 20 million. The machinery is still reflecting in the Cherry Limited closing balance sheet for the financial year 2023 and will be depreciated in the future. So whenever this machinery will be depreciated in the books of Cherry Limited, FTA will allow Cherry Limited this depreciation as an allowable expense. So this depreciation will reduce the taxable profits. So the depreciation of the machinery will impact Cherry Limited future taxable profits. Since Berry Limited is a UK-based supplier and transfer pricing rules are applicable, transfer pricing rules are in place in UK. So for this recent transaction, we can assume that the machinery is priced at the market value. We can assume, but this is not hard and fast rule that you should not look into this. You can look into this, but risk is very minimal. Some balances will require adjustment to bring the arm length. And how will you bring the balances at arm length? Now, this is the question. Now we have decided in our previous discussions, we need to do the analysis of the balance sheet. Some transactions, some balances will not be required any adjustment. Some risk is very minimal. Some risk is very high. Now we need to identify those balances. And after identifying those balances, we need to bring those balances at the fair market value. So if machinery, you can take the straightforward valuation method. We know that what are the various valuation methods are prevailing into the market. We all know this is the cash flow method, free cash flow method, replacement cost method, historical cost method. So we need to bring those balances on the fair market value. First thing, we need to bring those balances into the fair market value. Important question. I was just discussing today with some very important big client. They were asking if the balances are reflecting into the balance sheet on the cost less accumulated depreciation. Might be there's a possibility that the business is following cost model. And based by following the cost model, if the balances are reflecting in the balance sheet cost plus costless accumulated depreciation. WDV is costless accumulated depreciation, and they have not gone for the revaluation. Will they be required to revalue the asset, or will they be required to carry forward the asset? Because we can say these balances have been accepted under the IFRS principle. Do we need to consider these are the fair value? No. This is very straightforward rule. If it would have been considered under the IFRS, you know what is that? Article 61. They said you need to apply the accounting standards, consider the closing balance, prepare the accounting balance, calculate the accounting balances based upon the IFRS, based upon the accounting standards. Then the second 61(2)(b), the law is saying then you need to bring them on the opening market price. So means law is not accepting the closing balance of the latest financial year as per IFRS given into the closing balance sheet. We need to convert those balances as per the market value. And what are the ways to conclude a market value as we discussed? One is go for a fair market valuation. So the length price is used the fair market value of the assets and liabilities. We know how to calculate the fair market value of assets and liabilities. Various methods are there. Second is another way is to use the book value of assets and liabilities, adjust for the impairment revaluation. Might be you will be able to arrive. This is not hard and fast. I'm highlighting. It has not been given in the corporate tax law. This is my understanding. This is my knowledge, my understanding, what I'm going to share with you. So first approach is go and take the market value. Second is take the asset, go for revaluation, make any adjustment, whatever the price that you are getting, then it will be at the market price. Because whenever do the revaluation means you are going to bring the assets at par. So these are the methods, these are the techniques we can apply. The method will be used depending on specific circumstances of a taxable person. For example, if a taxable person recently acquired an asset, it may be appropriate to use the fair market value method. On the other hand, if the taxable person held an asset for a long time, it may be more appropriate to use the book value of the asset. Book value, whenever you need to revalue the asset. After revaluing the asset, make the adjustment, bring the market value, and then you need to carry forward with that balance. Just look into this example. Before the first tax period, SLLC acquired a financial asset from a company, WLLC. SLLC records the financial assets on a historical cost basis, 70,000 on its financial statement. At the beginning of the first tax period in June 2023, an independent expert valued the financial asset at 100,000. So the opening balance of the asset used for beginning a tax period should be 100,000 instead of 70,000 given in the books. I think I have taken this illustration from the latest general guide on the corporate tax law. So this is quite obvious here that authorities, FTA, is not considering the value given in the balance sheet. They are asking, okay, historical cost basis 70,000, independent expert. We have already discussed in the previous slide, we need to go for the valuation of the assets and liabilities. Independent expert is asking the value of the asset is 100,000. We need to bring 100,000 instead of 70,000 in our books. One more example, P Limited purchased the land and building from its related party, 15 million in 2010. The value is 15 million. They bought it in 2010. The building was revalued 20 million in 2018. After 3 years, the building was revalued. The value has gone from 15 million to 20 million. Initially, they bought the building from the related party. Just keep in mind. They have taken the building. They purchased the building from the related party. That building has been revalued in 2018 at 20 million. The written down value in the closing balance sheet, WDV in the closing balance sheet, latest financial year 2023 is 17 million. So might be 3 million has been depreciated. So however, yes, this is for sure it has been depreciated. So however, the value of the property has increased and the fair market value of the building is 19 million. Now the value of the building is 19 million. Therefore, the opening balance sheet for this building for the first tax period would be 19 million. So original cost 15 million, revalued 3, total 18, depreciated again by, revalued 15, revalued by 5, total 20. Out of this 20, 5 has been depreciated, remaining is, 3 has been depreciated, remaining is 17 million. Now it is again up, the value has gone up, it is 19 million. We need to bring 19 million for tax purposes as an opening balance. No matter which method you are using, opening balance should be brought on arm's length principle. We know this arm's length principle not only applicable for the related party and connected person. Whatever the balance reflecting in the closing balance sheet, we need to bring it as per the market price as an opening balance. I just want written one thing. This is on my analysis that you can make the cluster of transactions as well. Suppose one party has bought a material. There are thousands of transactions for the material with the same supplier, same customer for the whole year. Closing balance, what are the closing balance reflecting? You need to do the calculation in one Excel sheet. Then go ahead and make one single adjustment. We can make the cluster of transactions. So what you need to do right now for the how you can enter, because a lot of businesses they are going to implement the corporate tax starting from 1st of January 2024. What they need to enter? They need to close their books. They need to get their financials prepared as per IFRS. And we know this. If the value of the business tax turnover is 3 million, you can apply cash basis 50 million short SMEs, IFRS for SMEs, and if more than 50 million full-fledged. Though this is not applicable, this is applicable. This criteria is applicable starting from 1st of January 2024 from the effective date of the law. But still, I'll recommend you need to go ahead and prepare the closing balances based upon these principles. Once you are preparing closing balances based upon these principles, based on applicable accounting standard, based upon these principles, then you need to do the analysis of your balance sheet and identify those balances which needs to be revaluated. Either discuss various scenarios, get the valuer, appoint the valuer, get your property valuer, get your machinery valued. Then whatever the valuer is asking, expert is asking, latest balance sheet value, then you need to carry forward with that amount. So it will lead to deferred tax assets and it will lead to deferred tax liabilities, because the balances reflecting in the financial statements as per IFRS, it will be different, and the balances that are being carried forward, these may be different. If these are different, so the impact and the IFRS 12 application, deferred tax assets, deferred tax liabilities application will be there. Though usually these deferred tax liabilities, deferred tax assets usually arise through the depreciation, amortization, impairment. But during the period, there are no difference in between accounting depreciation and tax depreciation for that time being. Just keep in mind, there are no deviation, there are no difference in between impairment as per IFRS impairment, whatever is required for tax purpose. These are both same for the time being. But these opening balances, there is a possibility that it may lead to deferred tax assets and deferred tax liabilities. So this is over from my side. As usual, if you are in need of any support, impact assessment, implementation, advisory, and compliance services, it would be pleasure supporting you. You can reach out to me, mahar@crestcooper.com. You can reach to faiza@crestcooper.com. And so we are always ready to listen, ready to understand, and ready to deliver. You can approach us 3391-488. You can drop us an email, info@crestcooper.com. This is over from my side. If you have any question, you are most welcome. No question? If you have any question, you are most welcome. No? I think that the topic was very simple today. Okay, guys, take care. Thank you very much. I really appreciate it. Have a lovely evening. Thank you. Bye-bye. Bye-bye.